Hello, Domingo. Hi, Jen.
Where are you guys coming from? Domingo, how's it going, man? You guys are early to the party.
Yeah. Just have to remind everybody to raise their hands and put the questions in the chat throughout the whole.
Yeah,
webinar.
and then we'll have Q&A at the end.
Yeah.
And then I'll look through the chat and I'll hold your guys' questions.
And then we can do the social media questions at the end, yeah?
Yep.
Yes. Thanks again, Bethany, for being here.
My pleasure.
Yes.
We are
Happy to do it.
excited. Jen.
Welcome, Jen. There's 2 Jens in the room.
I know there was some people who couldn't make it because of the time, but we're definitely going to send out the replay to all those who registered.
Perfect.
Thank you guys for coming early, for popping in. If you guys do have any questions, raise your hand. Use the raise the hand feature and share your questions throughout the webinar in the chat, and we'll go in order of them
Yes.
being received. Now, nice to see you.
Okay, it is 10 a.m.
Vance.
Perfect.
Thank you guys for coming.
We'll give it like another minute or two and then we'll get started.
Okay.
Yeah. Good morning, good afternoon to wherever you guys are at.
Wonder, everybody at work, or are they at home or working from home? Aloha, Rosa.
Aloha, Bethany. How are you?
I'm good. How are you?
I'm good. Great to have you. Thank you for this opportunity. and your
My
time.
pleasure. Thanks for having me.
Hey, how's
And
it
to
going,
everybody
Clay?
tuning in, oops, sorry. Everybody tuning in, feel free to network in the chat. Drop where you're at, what you're looking for, what you may need, how we can help you.
Yes. And
All
also,
right,
if you have questions throughout, please put it in the chat. Use the raise your hand feature, and we'll get to you guys in order of who puts it in first.
Yes, perfect.
Everybody's loading up. Yes. Atu. Yoshida. Oh, my mom's here. Hi, Mom.
Hey, Mom.
Hey, Mom.
Hi, Atu. What's up,
What's up,
everybody?
Papa? Yeah.
Thank you guys
Thank you
for
guys for
coming.
putting this on. It's a great
Yeah.
opportunity.
Yeah, thank you.
Yes, we have Bethany, and we're so excited.
Yeah. A legit SEC attorney, guys. She is incredible.
Right. All right, it's 10:02. Let's go ahead and get started.
Okay. Well, thank you guys for being here today. We're here with Bethany LaFlam. She is our guest speaker of the day, and she's going to be talking about all things SEC. She is an incredible SEC attorney, and we are AR Capital Partners. And we'll be hosting more of these webinars, probably monthly, just to educate and inspire our community and get everybody in the know of real estate, bigger real estate games. So yeah. And Kehal is going to take it
Awesome.
away.
So just like Huakle said, we are AI Capital Partners. I am Kehal. You guys met Huakle. If Chris, you can just say hi.
Chris, yo.
Awesome. So just a quick introduction of us. We've been in the real estate game collectively for about 5 years now, and we've done over 6 million in real estate transactions. We have recently pivoted to the multifamily space, and we have invested over $80,000 to get us started. But that just in turn gives us resources to pour back into all of you guys. And that is our mission, is to be able to help 1,000 families on their financial journey and be able to reach that goal through investing in real estate. So like Huakle said, we're going to be having more webinars coming on. And if you guys have any questions, if there's something that you guys are looking for in specific that we can help you, that's exactly what we want to do. And we want to be able to provide those education and resources to you guys. So that's a little bit about us. And then I'll let Chris go ahead and introduce our amazing speaker today.
Awesome. Thank you, guys. So welcome, everyone. We'd love to introduce Bethany LaFlam. We first met her at Peak Partnership 2023. It's a convention where all these multifamily syndicators and investors come. So she was on stage, and we were excited to say, hey, Bethany, we want you to help educate our people here in Hawaii and all over. So let me introduce her. She is an entrepreneur, a seasoned deal lawyer, a mother, and a visionary. With more than 20 years of experience practicing law, Bethany has leveraged that expertise in her business life. In her role as managing partner of Premier Law Group, she focuses primarily on real estate syndications and funds, helping syndicators build their empires by safely leveraging OPE, or other people's everything. So some industries she's been participating in is aerospace, oil, gas services, medical services, and tech. So she's an amazing entrepreneur as well. Give it up for Bethany. Yeah.
Thank you.
All right. Go ahead, Bethany.
Thank you guys very much for having me. I really appreciate it. I know there's a ton to cover, but I will cover kind of high level, and I know we've got it opened up for questions in a little bit. So if you have questions, please raise your hand, type it in the chat, whatever, and we'll get to those. For really high level, when we talk about SEC for multifamily, a lot of people want to know, why does the SEC care what little old me is doing, right? Why does the SEC even care what you're doing? And when the SEC will care is really when you are going to go out, like we said, raise OPE, other people's everything. So starting with other people's money. So if you are going to go raise money from passive investors who are going to rely on your efforts or your work in order to get a return, then you've sold securities, which means the SEC cares what you're doing. And so there are some rules around that. Most people in the real estate space, when you're raising money, are going to be under what we call Reg D, 506B or 506C. So we'll talk about what 506B and 506C is in a second. And Reg D is really, or 506B and C, those are exemptions from registering your security. So the general rule is, if you're raising money from passive investors, you have to register, right, with the SEC. That's like Microsoft or Facebook, right? These big public companies, those people have to register their offerings. Now, in the real estate space, that's a little much for what you guys are trying to do, right? I mean, it takes several months. It could be hundreds of thousands of dollars. You guys usually have about a 45-day window for your closing. And, we're talking about a couple $1 million. And so you want to find an exemption from having to register that security. And those are your only options. Otherwise, it is illegal. So we hear people say, well, I'm just going to do a joint venture, for example. A joint venture is actually not a security, but you don't get to decide which it is. The facts will decide which it is. So the answer really is, if it's passive, meaning your investors are not doing anything other than waiting for mailbox money off of your efforts, then it is a security. If you don't want to do the compliance of having a securities offering, which we'll talk about today, then you want to find a job for everybody. And a joint venture really is where everybody is a partner in the deal and has an active role in the deal. So that's a joint venture. So it's not a thing that you get to decide, oh, I don't feel like doing securities regulations. I don't feel like doing all the compliance work, then I'm just going to do a JV. Even if it's only a few $1,000s, even if it's just your mom. I know somebody's mom is on here. Hi, mom. Even if it's just you, mom, it's a security if you're passive. All right. And so you want to make sure that you choose your facts wisely. So the good news is this: most of the things that the SEC will provide regulations on, all of their analysis is really going to be a facts and circumstances analysis, which means if you don't like the answer, then change your facts. Right. And that's why you get to decide, okay, well, maybe we only have 4 people. We're just going to give everybody a job. We're going to make sure everybody can vote. Everybody has a say in how we're going to maybe do the asset management, something like that. Then you could do a joint venture. But otherwise, you're really looking for an exemption from having to register that. The investor relations regulations, this is really kind of all the same. This is sort of the same umbrella, right? Investor relations, we'd like to say investor relations over capital raisers, because again, you're under an exemption. The reason that you all are allowed to go raise capital for these real estate syndications is because you're actually raising money to operate your syndication business. You're operating an asset. Right. So because you're operators, you can go raise money for your own business. It's what we call the issuer exemption, right? Even though technically the company's the issuer, you're allowed to go out and raise under the issuer exemption. That exemption, it's the same thing as, for example, like I keep saying Facebook and these public companies, they went out and they raised capital, right? There wasn't a capital raiser on the team. They just raised capital to operate Facebook. There's not like a whole capital. I mean, yes, it's a big job. And yes, they had people have to help them. But when you think about setting up your business, you think about capital raising as sort of just a thing you need to do so that you can operate the business. But everybody involved really needs to have a real job in operating the business, including the people that are raising capital, because otherwise you have to have a broker-dealer license. Right. And so most people in this space don't have and I don't mean a real estate broker, I mean a FINRA broker dealer license with the securities, a securities license. So those are the regulations that you're all operating here. So you're allowed to go raise money, excuse me, on the issuer exemption for your operating business. Excuse me one second. Now we talked for a second about 506B and 506C and what those two exemptions are. So 506B is an exemption that allows you to go out and raise money from other people, and you can have up to 35 sophisticated but non-accredited investors. And that means if you allow anybody who's sophisticated but not accredited into your deal, you cannot advertise or generally solicit. So you can't put it on Facebook, you can't put it on LinkedIn, you can't talk about it on a webinar like this. You've got to keep it really in your tight circle, meaning everybody that you go raise capital from, you should already have a substantial pre-existing relationship. That is the best way to show that you did not advertise or generally solicit. Now, I say this, and I always like to remind people, though, that you are allowed to take referrals. Okay, so you can take a referral. So for example, if I come on and I say, I really love this deal, I'm going to put in some money, and it's a 506B deal. And my sister, she likes to invest in everything I invest in. Can I send her the materials, or can I have her contact you? You can accept my sister as an investor, provided that I did not go out and generally solicit on your behalf, and provided that you do not pay me to bring my sister into the deal. Right. And so that is a 506B. Now, what is sophisticated versus accredited before we get into 506C? Accredited investors currently, we think this may be changing, but currently accredited investor means anybody who has income of more than $200,000 annually for the last 2 years, and then reasonably expected again this current year, or 300,000 if you're going to count your spouse. Or another way to be considered accredited is if you have more than $1 million of net worth, not including your primary residence. We exclude the primary residence, otherwise everybody in California would be already automatically accredited if they own a home. So that does not count. We always suggest, by the way, that syndicators do this third-party verification that's going to be required for 506C. We tell you, you really need to use a third party. You don't go and verify that because net worth is actually a little bit more complicated than you might think. You have to take into account all the liabilities in addition to all of the assets and the income. 506C is where you can do an offering and you can accept only accredited investors. Everybody has to be accredited. Nobody's sophisticated, nobody not accredited. And when I say sophisticated, by the way, I'm non-accredited and sophisticated, I'm using interchangeably, but they're not exactly the same. Really, even if someone is not accredited, they still have to be sophisticated enough to have enough business acumen that you can safely accept their investment, meaning you shouldn't take someone's last $10,000 if you know that's their last $10,000 and they're unemployed, for example. You shouldn't take an investment from someone who really has no idea what multifamily even is, or doesn't understand business or doesn't understand real estate at all. So you want to make sure that when people are investing in your deal, they really know what they're getting into, and that's to protect you as much as it is to protect them. So when I say sophisticated, yes, non-accredited, but not uneducated. They still have to be knowledgeable. So in 506C, again, everybody has to be accredited. That means, though, that you can shout it from the rooftops. You can talk about it on Facebook. You can put it on LinkedIn. You can have a webinar to the masses. You can take out a billboard on the freeway if you want to. You can advertise. The limitations there are, one, that everything you say has to be truthful and it cannot be misleading. And then B, as I mentioned a moment ago, you have to take reasonable steps to verify that the investors are actually accredited before you take their money. Not before you advertise to them, but before you take their money. And as I mentioned, it is beneficial to have a third-party verification source. I would never advise you as a syndicator to take on that liability yourself. So there are companies out there that are available to do third-party syndication. One of them is called Verify Investor. Another one is called Parallel Markets. I know there are others as well. And some of the platforms will provide, the investor portals will provide those relationships for you. I know a lot of you use InvestNext or Cashflow Portal. They have relationships with third-party verification services. Which I should also mention, by the way, if you are doing a real estate syndication, I highly recommend that you do use an investor portal to keep yourself organized and keep records for your investors. And also, especially if you're doing a 506B, to show how you have that substantial pre-existing relationship with your investors. So if there's ever any question about something someone posted or so how someone found you, that you can show, no, they did not come in as a result of any kind of advertising or general solicitation. Here's how I knew this person, right? And anybody who's heard me talk before, you've probably heard me mention the 8 steps from turning a stranger into a 506B eligible investor. Anybody who would like to have that, let me know in the chat. We'll make sure that everybody on here gets a copy of the 8 steps from taking a stranger to a 506B eligible investor. I'll send that to you as well. So I know that probably raised a lot of questions, and we'll get to those questions. And I just want to talk briefly, though, about the benefits of a fund over a single asset syndication. Of course, starting with what is the difference, right? I love funds so much, and I'll tell you why. But the fund and a single asset syndication. So a single asset syndication is kind of what it sounds like, right? You go out, you find a property, you go raise capital for that property. You give all the disclosures about that property, you raise specifically to close it, you do whatever value add or whatever your business plan is, you do it, you give everybody what you say you're going to give them, and then it's over, right? So that's a single asset syndication. That is great because, when you're going out and raising capital from investors, you get to tell them about a specific property, they get to see it. Investors love that, it's a little bit more concrete. A fund is when you go raise capital for more than one property, some of which you may not have, or maybe none of which you have identified yet, So when you haven't identified a property that you're going to go raise capital for, we call it a blind pool fund. And what that is really is you're telling investors, hey, investors, you're investing in us as a manager to go out and find great properties. And here's our list of criteria, right? And trust us, we're going to go find great properties. We're going to manage them. We're going to hopefully provide a return. And so the investor is really investing on the jockey and not the horse, right? So the management team and not the asset. Now it could be in a fund that you've identified some of the properties. So that's a hybrid, right? Where you say, oh, we've identified this one, but we're really going to go find more like this investor. In my opinion, that's kind of the best of both worlds, because you give the investors the comfort of getting to see how a property has performed historically, getting to see what your specific plan is for that property and how you're going to generate some projected return for them. And then you say, hey, we're going to also go find more like this, right? So it gives the investors kind of the best of both worlds, and it gives you the best of both worlds. The thing, though, I love about funds, and you really do need to have a track record before you raise for a fund, only because it's hard to get investors to commit if you can't show them a track record, right? But funds are great because you have cash already raised and ready, so you're not chasing at closing. Meaning you find a property, you've already got, let's say, $3 million committed. Some of that might already be collected. You find the property, you just go call that capital in and you get to closing all that much faster. Or even better, you might actually have more bargaining power because you have cash ready. You're not waiting for a raise. It's not contingent on a raise, but that you can close. You can go in with fewer contingencies, for example. So you might be in a better position to win a bid in this market, right? You might be in a better position to win a bid if you have a fund. The other part of that is, and I don't know if everybody knows this, you could actually raise all of the capital if, for example, I don't know, the lending market's not that favorable, right? And so if the lending market's not that favorable and it does make sense and pencils for you to raise most of it in equity, then you can have an all cash offer, for example, which might give you some leverage with a seller. So the fund is a really great way to get some flexibility for you to operate. It's not perfect. You have to really consider a lot of things. It's not as simple as a single asset syndication. You really have to think in a fund about how people get in and how people get out, right? And how people get in, an example, let's say you're raising a $10 million fund and you haven't identified any properties yet. Well, if an investor commits and you're giving a preferred return, for example, you may not want to collect all that money up front. So you just have to think about how you're going to collect the money that you have committed from your investors. The other part of that is in a single asset syndication. When you finished your business plan with that property, you sell that property, you do a cash out refi, whatever it is, you're done. In a fund, you've got multiple properties to contend with. So you have to talk about the different ways investors can get out or different ways the fund could end. It could end when you've sold all the properties. It could end after the passage of some amount of time, after you've delivered a certain return. You may offer ways for investors to get out early. You may decide you want to buy investors out early. So there are a lot of things to consider that make a fund a little bit more complicated, but it does provide a lot of flexibility for syndicators who've got a good track record. I don't typically recommend that first timers out of the gate go and raise a fund. Again, just because it's not illegal. Anybody can go raise a fund. It's legally you can do it. The problem then, of course, as I mentioned, is it's harder to get investors to invest with you if they can't see what you've done or that you've done what you're saying you're going to do sometime before, right? And you can show them you're a good asset manager, even if you've financed your own deals before. You don't necessarily have to have syndicated deals before, but you probably should have some experience in operating deals prior. Now I'm going to pause for 1 second for questions. Because I tend to be a little long-winded when people ask me questions and give more details. I keep it really high level here, and then when you have questions, I dig in a little bit more. So I want to open it up for questions for a moment, if I may.
Yeah, of course. And I know, Bethany, a lot of people were asking about the 8 steps.
Yeah,
Got about 7 or 8 people asking about the 8 steps. If maybe you can touch on that.
absolutely. So the 8 steps is actually guidance direct from the SEC. So we didn't make that up. The SEC gave us guidance to say, hey, here's a good way to show us that you didn't generally solicit and that you didn't advertise and that you actually do have a substantial pre-existing relationship with this person that you are inviting into a 506B offering. And the thing to remember about it is that it is not a certain amount of time or a certain amount of touches. You can't just decide, oh, I've talked to this person 3 times. We've been doing it over the course of 6 months, so we're good. It's not quite that simple. It's really more quality over quantity. So the quality of the engagement. One of the things that's included in those 8 steps is a questionnaire, for example. I highly recommend that you create a process within your syndication business that every time you meet somebody who's a potential investor, that you start them through a specific process that is included in these, or that includes these 8 steps, so that when you do have a 506B offering, you can offer it to them. And one of those things is a questionnaire. And the questionnaire is going to ask things like, what are your investing goals? How much do you have in assets? How much experience do you have? What asset classes do you like? So you're going to really get to know people. Then I would recommend that you follow up with a Zoom, or if you can, an in-person meeting, some additional communication. So it's not going to be good enough to just, for every month for 6 months, you're sending them a newsletter and an email. You really actually have to have a connection and an interpersonal communication going with this investor, know something about their goals, their family. And the reason is, let's say, for example, you've gone through some kind of high level steps, like, I've been emailing back and forth and I think we're good. Go ahead. I have this 506B. They invest with you, and maybe you haven't gone through the whole 8 steps and you've kind of just sort of, been emailing them, and the deal goes south and they lose their money and they go make a claim with the SEC. If the SEC starts poking around saying, wait a minute, that was an illegal offering because you advertised or you generally solicited, you didn't know all these people, that person is not going to be a good witness for you if you've just lost all their money, even if it's not your fault. So you need to make sure that you have really good records of how they came to be in your deal. And that's why I say you follow the 8 steps. That's why I say you should have really good, CRE, or CRM rather, if you have like HubSpot, something like that, keep really good records there, and then keep really good records in your investor portal as well of all the different ways that you've gotten to know them. So the 8 steps is going to go a little bit more in detail than that, but the high level, it really is it just means it's a quality of the interactions, not just a certain number of touches and not just a certain amount of time. And I don't see the question. I see that there's the chat.
Sense. Thank you.
All
We
right.
have a question from Sam. He says, I'm currently driving, but my question is, what do you think is going to change about accredited investors?
That's a good question. There's been a lot of speculation about the minimum net worth going up. So some people have speculated that it'll go all the way up to 10 million. Some people, my partner included, think it's going to be 3 million. But the speculation is that number is going to go up. It hasn't changed for a very long time. And so $1 million today is not the same as what $1 million was when the law was passed. So it may be a little more difficult to do 506C deals if that number goes up well over $1 million, right? A lot fewer people are going to qualify. I don't really think it's going to be 10 million. And frankly, this has been talked about for years and years, and we're really not that much closer to an actual answer, although we do continue to monitor it. So of course, you'll be hearing it from me all over the place when it does change. But what it looks like is that it's going to potentially go higher than $1 million. I don't know about the income though, 200,000 or 300,000 if you're married. It's the net worth. So people with the high income might be still in the running. But if that happens, we might see more 506B deals, which means start developing those relationships strong now.
Awesome. Thank you so much.
Yeah.
Domingo raised his hand too. So Domingo, if you would like to unmute yourself, you are be able to ask your question.
Hi, Bethany. Hi, everyone.
Hi.
How are you? Bethany, my question is in regards to my current business. So me having a small business today, you and I have been on a Zoom meeting recently with Sam and Gerardo, Brian. So because I am in the small business now, and I have a relationship that's been long years already with these business associates of mine, clients or customers, if you will, would it be advice for me to stay away from them because I do have a current relationship in business with them? Or would you advise me to go ahead and pursue them with an offering for 506B? offering?
So I would review the 8 steps first to go through and make sure that they check all those boxes. So for example, you may not know all the things that are in the questionnaire about them. So there may be a few things you can still do to elevate that relationship before you pitch them a 506B deal. That said, if you've got if it's somebody that you've been going to happy hour with for 5 years every Thursday, and their kids and their spouse or whatever, that's probably enough. So for example, like I would argue that, some of my family members that I've known obviously since I was born, I don't know all of their, investment goals, but I could still approach them. Right.
Right.
But that said, you're going to have better results anyway, if you know those things, because you're going to know better, is my deal really appropriate for them? Because maybe it's not. And so you're going to be in a better position to help them than if you know more about their goals. So I would say still follow the 8 steps. And some of them you might just be able to skip over, like I've done that. Good. And it's just checking, right? It might just be checking the box.
Right. Would you consider that, and I'm sorry if I'm just doing a follow-up question on it, but would you consider it to be a conflict of interest if I am offering these 506B deals to business associates of mine, customers of mine that I do business with for 2, 3, 5 or longer years?
Only if it's a conflict of interest at your current business. So
Okay,
if it's going to jeopardize your position, somehow with them as a customer or a client of that current business, then yes. But in terms of on the security side, no.
Okay. Wonderful. Thank you.
Think about it this way: when you're offering these opportunities to people, this is not really legal advice, is more practical advice, is you're not asking them for money, you're offering them an opportunity, right? And you're going to have a lot more success if you approach it that way anyway. And if you think about it that way, then is it a conflict of interest? Probably less likely to be, right?
Right. Okay. Wonderful. Thank you so much. I appreciate it.
Sure, of course.
Awesome. Thank you so much. And we have one more hand raised. Faze Rumi. I don't know if I said that right, but if you can unmute yourself, you can go ahead and ask your question. Thank you.
Bethany, thanks for your time. Just a really quick question on the investors that I referred. If you bring in, does that, if you have referred investors, does that take away from your 35-person cap in a 506B?
If they're not accredited, yeah, they do count. They count. Everybody does. And in fact, follow on to that, just so everybody knows, is when you have an LLC that invests in your deal, every member of that LLC who's not accredited counts towards your 35 as well. So you need to actually look through the LLC to see if all the members, and have them all fill out the investor questionnaire to see if they're accredited or not.
Gotcha. Thank you very much.
Absolutely. Another hand raised.
Yes, I don't know how to say that. I don't want to butcher your name.
Atu, you can unmute your mic.
Thanks, Hockley.
Okay. Thank you guys for putting on this Zoom, and Bethany, thank you for your time. I know you're very busy. So I was wondering if you could say those sites for investor verification again,
sure.
please.
Yeah, verifyinvestor.com. And the other one is Parallel Markets. And if you just Google, honestly, if you just Google accredited investor verification, you're going to get, a list.
Okay, right on. And then thank you for that. One other question I had was that are funds something like ETFs in a sense of investing and benefits? Exchange traded? Not really.
Not really, not in this context, right? So we're still just talking about real estate assets, just multiple real estate assets. So it's still gonna be private. You're gonna pick them, and then usually what happens is the investors, they're gonna get kind of like you're asking, they're gonna get the benefit of a more diversified portfolio. Sure.
Yes.
So in that regard, yeah, similar, but this is all going to be private, still private syndications. It's the exact same law as a single asset syndication. It's the same exemptions. It's just a little different structure.
Right on. Thank you so much for your time. Awesome.
Of course. Yeah.
Oh, Jen had a
Okay.
question in the chat. She says, what are your options if you exceed the 35 cap for non-accredited investors? Just wanted to make sure we didn't miss that.
I mean, I would continue to develop the relationship and invite them into a future deal, but you can't go over. So what I would do though is when you're doing the offering, it's a lot of times a first come, first serve, but as you're filling it out, if you're kind of getting close to the wire, I would give it to the higher investors or the investors you more want to work with, right? But because you are going to have to cut some people out if it's over 35. That's where you have a lot of leverage though, because you can just say, I only have 35 and there are 38 of you. So I'm going to take, the 35 best ones, whatever best means to you. Best is not necessarily always the highest investor. Because keep in mind that you are still going to have to be dealing with this person for the next probably 5 to 7 years, the life of most deals, right? So I would make sure that it's a good fit, but you will have to cut people out, unfortunately.
Awesome. Thank you for that.
Sure. And something that sometimes people will do is if they have really good qualified investors that either aren't a fit or don't make it into their deal because it's full or for this reason, if you have too many non-accrediteds, a lot of sponsors will refer the investor to a deal that makes sense for that investor's goals. Because again, this investor, right? You've done all the 8 steps and you know what they're trying to do. It gets a lot of goodwill to refer them to a deal that's best for the investor, even though you can't get paid from that sponsor for doing it. I think you probably, if you all were on here, if anybody here was at Peak, you heard Ryan talking about how sometimes he just hands them to other people that are doing deals and it's just goodwill and it comes back in time, even though he doesn't get paid for it. It's a really good practice. This is not necessarily a zero-sum game. There are plenty of investors out there. And if your deal is best for the investor, then you're going to get them. If it's not, then they're going to remember the fact that you helped them. Again, not legal advice. So it's just kind of practical advice.
Bethany, we have another question in the chat, and this one actually came from social media and Sam just asked it. So the question is since a lot of us are new, if we are doing a 506B raise and someone announces it or promotes it, what happens? And that's kind of one of the questions we got from social media is what happens if you accidentally mess up? What are the consequences, if any?
So it's a really good question. So unfortunately, if anybody on the team accidentally or otherwise advertises or generally solicits, 506B is no longer an option, which means everybody who comes in has to be accredited and you have to take the reasonable steps to verify them. And the other unfortunate part is if that happens after you've already taken money, now you're in violation of both 506B and 506C because you didn't already verify them, right? So if that happens, what I would recommend, well, first thing before that happens, I always recommend talk to your sponsor team, everybody on the GP team early about what your goals are and what your investment philosophy is and all of these things. So everybody's on the same page about what you're trying to do. So everybody knows what they're allowed to do. But if it happens, and what I would say is what you need to do is anybody who's not accredited, you need to refund their money. And then anybody who is accredited, you need to go verify them and have them re-sign documents after they're verified saying that they want to stay in. You can hear what a pain in the ass that is, right? So you definitely don't want to be in that position, which is why I always say talk to your deal team first and make sure everyone's on the same page about what you're trying to do. And accomplish, and also get them on the phone with the lawyer so that they know what the rules are, because of course, not everybody even knows the rules. I mean, why would you unless someone tells you? That's why I do so many of these with students, because I never want you to be in this position that somebody on the team just simply didn't know. And they got so excited, they put it on Facebook, oh my God, we're under contract. This is so awesome. And everyone else is like, yeah, but I wanted my mom to come in, right? That's exactly why we do this education.
Oh my gosh, that's huge. Communication is everything.
Absolutely.
We have another question this is from a passive investor. And it
Right.
says, as an investor, what happens if the syndication team does not meet their preferred return?
It depends on what the documents say. The documents should line out what the rules are around the preferred return. Most of the time, the preferred return does roll over to the following year and it continues to accrue. Not always, though. So you really have to make sure you're reading the documents to see and make sure you really understand what the rules are around getting paid, what the waterfall looks like, what the pref rules are as a passive. But if it does roll over, that just means it's going to continue to accumulate so that either when there's extra cash flow or when there's a capital transaction event, meaning a refi or a sale, then you'll get caught up then. If it doesn't roll over, the slate starts clean from the next year, and that year you are just short and you don't get it. So it's really, you can hear it's really important to know what the deal is ahead of time, but it's going to be driven by what the documents say. So that's going to be in more than one place. It's in the PPM in the disclosures, but it should also be in the operating agreement, because the operating agreement lives on after the raise is done. That is how everybody is actually operating the business as it sounds. So it should be outlined in there. So make sure you ask that question prior to investing for sure. I recognize that image, Dante.
Chris, you have a question?
Yes. Go ahead, Dante. Go ahead, brother.
Can you hear me? Sorry.
Yeah. Mm-hmm.
Okay. Hi, Bethany.
Hi.
I just wanted, because I've been in a couple of your talks, to have you touch up on one of the things that you spoke earlier about, if someone speaks up about the deal and we're still in a 506B, let them, if you can touch up on, it also applies to like the other investors. If they say about the deal too, then it cancels as well, right?
Yeah. So what I would do is, as you're talking to your investors, let them know this is only available to our close group of people we know well. So you please keep this private to yourself. So when you send them the business plan, or when you send them, when I say business plan, I mean your pitch deck, your slides, send it the PPM. When you send that to them, make sure that they know, and it says everywhere, this is private and confidential. This is for your eyes only, or for your advisors. It is not for you to share anywhere. And I would make sure to tell all the investors, because you don't want them to think they're helping you by like, oh, I'm going to help you get some investors because I love this deal. And then inadvertently then go advertise or generally solicit on your behalf. So because that would blow the exemption for you for B. So even from the very first time you communicate with them, you should let them know this is for your eyes only.
Ooh, that was good. Thank you. Okay, so another question from Carolina Enriquez is, what is the benefit of being accredited versus non-accredited?
Well, I mean, other than you have a higher income and higher net worth, that's always a benefit too, right? You could get into any deal you want. It doesn't matter if it's 506B or 506C. You don't have to be non-accredited to get, of course, and to get into a 506B. So you just have access to whatever deal you want. I mean, some people might argue that the better deals are 506C. I don't know that that's always true, because that really just depends on what the GP team's investment philosophy is. A lot of times people will do 506B just because they want to provide people who aren't accredited the opportunity to start building their wealth. So it doesn't mean it's not as good of a deal. It just means that's what their philosophy is. So other than, having more capital at your disposal, it's just, you can pick from literally any deal, 506B or 506C is the benefit.
That's amazing. And definitely that is our goal, all of our goals, to be accredited. So we have a world of investments to jump into.
Exactly. There are a few other ways to be accredited. One of them is you can actually test in. Certain licenses will allow you to be accredited. We didn't really touch on that because it's not the typical way. But if you get your Series 65, for example, and then you hang your license, it's a lot of steps. But the Series 65 is one way that you can actually test into being accredited. So it's just food for thought if you're working on becoming accredited. And the other thing too, just so that you all know, is if it's your deal, meaning you're an executive, you're the manager, you're the one calling all the shots, it's your deal, you don't have to be accredited to invest in your own deal, even if it's a 506C. Now, that does not mean you can just put a bunch of people on the GP team who aren't accredited so they can invest. You've actually got to be an executive and a manager in the deal.
Awesome. Awesome. Thank you so much, Bethany. We have 2 other questions. And then just for you guys, want to just let you guys know it's 10:42. So we want to be respectful of Bethany's time too. So we're going to be wrapping up Q&A shortly. But the 2 questions, and I'm just going to read them both here for you. So Ben asked, could we also make them sign an NDA as part of the process? And then from Chelsea, it's how long is the verification process and what does that entail, or what does it look like?
So you can have people sign an NDA, although a lot of accredited investors won't. And the reason for that is they're looking at a lot of deals, and the NDA is really to protect something that you created. So your business plan, or this isn't exactly like you invented something, this isn't going to be so out of the ordinary that it would necessarily matter if anybody went and told anybody else about the deal. I don't know the context of the question, if you're asking them signing an NDA so they don't go blow your exemption, or them signing an NDA so that they can't reveal like the secrets of how you did your underwriting. I don't think you need to go so far as an NDA to get them to not tell people about your deal for advertising purposes. And frankly, even if they violate it, you already blew the exemption. So what are you going to sue them, right? It's probably not really that helpful for you to bother, if that was the context. And the other question is, how long does it take to get verified as accredited? Once you upload all the documents onto the portals, whether it's Verify Investor or Parallel Markets or some other one, the investor will have to upload either its W-2s or their financial statements. Once they've done that, it's less than a week, I believe, and you just get a letter that says, "Hey, congratulations, you're accredited, you're verified accredited." And those letters are going to be good for 90 days once you do get it. But the good news is, once you've invested with a certain sponsor, that letter, provided there are no material changes to your accredited status, is actually good for 5 years only with that sponsor. So it's really great for sponsors, because it's just easier for accredited investors to invest with you a second time than to go get verified again.
Awesome. That's huge. Domingo's back on. Do you want to ask your question?
Yeah, hi. So my question's in regards to collecting funds. When is a good time that won't get you into any trouble with the SEC to collect funds, and how?
What's a good time? I'm not sure what you mean.
So if you're trying to collect capital from unaccredited investors, sophisticated investors, when is a good time to collect on those funds from them?
Well, you definitely don't want to start collecting funds until after you've had all your offering documents done and they've reviewed the offering, the PPM and operating agreement and questionnaire and subscription. They've had a chance to actually review all of the final documents and then sign. So never before that.
Okay.
In terms of like how much time, it really is going to depend on how far away you are and how much you're raising, how far away you are from your raise. I mean, the sooner the better. If you've already identified a property, because you're going to want to get to closing. So, but never before you have offering documents.
Okay. Thank you.
Sure, of course.
Okay, we have a few more questions in the chat. So there's about 3 or 4 more questions, and then we will let you go, Bethany. So thank you so much for your time.
Sure.
So do you recommend contracts being reviewed by a real estate attorney prior to engaging?
Absolutely. Well, prior to engaging the real estate attorney?
I think prior to engaging the investor. Walkley, you can unmute.
Yeah, I think it's the investor.
So, is this a passive investor asking? I mean, I always think you should have you should definitely always have contracts reviewed by lawyers if you have the availability. If you're talking about the investor documents, you'd want their advisors, the passive investors advisors, to review it. It doesn't necessarily have to be a real estate attorney. Real estate attorneys and syndication attorneys are sometimes different. I don't do real estate transactions, for example. But yeah, it's always a good idea to have attorneys review your documents if you don't understand what you're signing. If you do, and you've done this a million times, then that's fine. You don't have to go do that every time. But if you definitely If you don't understand fully what you're signing, absolutely, you should get somebody to review it with you. And by the way, most securities lawyers, or at least, I don't know, good securities lawyers, we do, will make themselves available to answer investor questions about their documents. Meaning if I do a deal for you as a syndicator and your investors have questions about what I put in the documents, I will talk to them.
Oh, awesome.
Yeah.
That's awesome. Dante asks if people in the GP gets the deal, do they are they accounted for as one of the 35 and a 506B? I'm guessing if they're non-accredited.
No, unless they invest themselves as passives. And again, if you're an executive on the GP team, then you don't count. You are accredited for that reason. So it just depends on what your role is in the GP. So not everybody in the GP necessarily is an executive. You can have 20 people on the GP that are all like, the shot caller. So it's going to be the executives on the team already count as accredited. And then anybody else, if they put passive money in as we call it class A investor, a passive investor, then they would count.
Awesome. Let's see. And it says, are there some things that you need to be careful about on social media, even if it's a 506 C opportunity?
Yeah, that's a really good question. Yes. And what you have to be careful of is any statements that are misleading without more context, right? Of course, it has to be true. I think everybody on here, it's sort of obvious that it has to be true. But beyond that, you want to be careful of saying anything that if there's no context or disclaimer, people might get confused by it and then it makes it misleading. So I usually say, if you don't have a whole big disclaimer, stay away from projected returns. For example, don't say, oh, we're going to get you X percent, return, because we usually put a footnote disclaimer on there that's not really, doesn't really fit into a social media post, right? You can talk about, this is an amazing property in Houston. It's value add. We're hoping in 3 years, and it's got whatever. You can say what the preferred return is if you want, but I would be careful about providing too many details. I mean, most people aren't going to invest based on a post anyway. You just want them to call you, right? So this is really top of funnel stuff. So you want to get them to call you to give them the real detail. So yes, the thing to be careful of is anything that might seem misleading without context.
Awesome. That's super good to know. And then last question from the chat is, as an LP, what are the main points to look for in the operating agreement /PPM?
Awesome question. The main things to look for are deal specific points, right? So the law is the law. I mean, the exemptions are what they are. You should make sure you understand who's on your sponsor team, the GP team. Who are you investing with? What is the waterfall? Is there a preferred return? Are there any splits of equity? What are the fees that the sponsor team is taking out? So I always say, make sure you read the definitions. People skip over the definitions, the glossary a lot, because they're like, I don't need to see that part. A lot of times what we do as lawyers is, if I have to define something that's complicated, I make a definition for it. And that way I can capitalize it and just use it a bunch of times throughout without explaining it 15 times. So the definitions could be very important. So you're going to look for where the fees are. You're going to look for a preferred return. You're going to look for any definitions that don't look like they're specifically, about securities law, for example. Make sure that you take a look at what the specific risks of this property are. Maybe you already know what the high level risks of multifamily are, but you didn't know that this one was sitting on a garbage dump or, Native American burial ground or something that you want to know about, like a risk that you want to know about that's on this property. So those are things you're going to want to pay attention to as well. Make sure that everything in the PPM and the operating agreement matches what you thought from the webinar or slide deck or whatever made you get this far. Make sure it all matches. But the most important thing is make sure that you know who you're investing with and that you have a good relationship with the sponsor team. That's a good sponsor team can be the difference between a deal making it and not making it, depending. The property is important, yeah, but the sponsor team, I think, is the most important thing.
Oh, for sure.
Definitely.
And I'm sorry, Bethany, I had one last question from social media,
Yeah.
and you already answered half of it, but this is talking about a sophisticated person, and what exactly is the requirements of a sophisticated person? What do they need to do?
So here's the fun part. You have to use your best judgment, which means there's no exact rule that says this is good and this is bad. Every set of investor documents is going to come with an investor questionnaire that the investor has to fill out, and it's going to give information about that person. And they're going to talk about, of course, where they live and how to contact them and all that. But they're also going to talk about how much they make, what's their business background, what do they know about investing, have they ever invested before? And you as a sponsor team are going to need to read that and make sure you're comfortable taking that person's money, given what they've told you their experience is. Right. So if they put in there like, I don't know, I just like you and I've got $10,000 and you agree to take it, that's probably not going to be sophisticated enough. If they don't understand what they're investing in, they've never done it before. And trust me when I tell you, you do not need the money badly enough to deal with that. Right. Because, first of all, it's illegal. But second of all, those people are going to be your worst nightmare, not because they mean to be, but because they don't know what's happening and they're going to be blowing you up. Every time, you give an announcement, you're going to have to spend time explaining what that means. And so it's never going to be worth it to have an investor who's not sophisticated enough to understand what's going on, no matter how badly you think you need the money. So make sure you have them fill out the questionnaire, make sure you read the questionnaire, make sure you're comfortable with their level of understanding and what they're even getting into in the first place.
Awesome. Thank you. We have one more question. Do you have an investor questionnaire sample from Domingo?
Yeah, absolutely.
Okay.
We can, when we send out the 8 steps, I'll have Ashley send that out.
Perfect. Thank you so much. I do personally have one more question. So we came from the single family space, and you mentioned earlier, talking about passive investors. We have a lot of fix and flippers in our community. What does that look like in terms of securities for passive investors or PMLs, right, in the single family space?
The rules are the same, whether it's multifamily or single family. So if they are passive, and they're waiting on you to do some work before they get their mailbox money, then it's a security. Now, even notes can be, and a lot of times are, securities. So you've got to be very careful when you take notes from private money as well. But the rules are the same. If they're passive, and they're holding out for you to do the work, then you've got to be compliant. And I recognize too that it's not always worth the compliance cost if it's like $100,000 and it's one person who's accredited, whatever. There are some things that you can do that are going to be more cost effective. So we can talk about that. But I would not recommend doing that with any non-accredited sophisticated investors though. Because the law is, if you're taking passive money from non-accredited investors, you've got to provide so many disclaimers that you're going to have a PPM. Right. And so it's, you want to make sure that that's worth the compliance cost. So maybe you talk about, we have a lot of fix and flippers that just are like, okay, then I'll do a fund because then I can at least raise money and do a whole bunch of properties.
Mm-hmm.
That's a lot of times what'll happen in the single family space is they just do funds. Some of our bigger clients that you probably all know in that space, they do funds.
Awesome.
That's so crazy. That's kind of mind blowing. A lot of fix and flippers don't know that.
They don't. I've actually spoken to crowds before. They were like, "Oh shit, I think I've been selling securities." Yeah.
I actually
tell
got
as
that
many people as I
question.
can. Yeah.
Your video yesterday, I think that I posted to my story. We were like, "Oh, this is just multifamily, right?" And I was like,
No.
"You know what? Let me ask."
Yeah, it's for every
Oh,
asset
crazy.
class. Yeah, and not just real estate. That's just securities. Yeah.
Oh my gosh.
Yeah.
We'll spread the message. We'll spread the word.
Yes.
Yeah. Sorry,
You guys
guys.
are doing good work here. Yeah.
One big question that was asked was, what if the asset doesn't perform, and if they don't get their preferred amounts, what are ways that passive investors can ensure they get paid their money back? Sorry, that was a big question that we wanted to ask earlier.
Yeah. Well, I mean, this is an investment and not a loan. And so if the asset doesn't perform, how you're ensuring that you're going to get at least the best you can is that you invest in a sponsor team that you trust is going to do what's best for the business under the circumstances. So we saw this a lot in COVID, right? Where rent stopped and people weren't able to pay the preferred return. The sponsor teams, the GP teams, they had to pivot and figure out what to do. And you've got to trust the sponsor team that maybe they ended up having to sell just to stop the bleeding. Maybe they had to kind of pivot the business plan a little bit. Maybe they didn't do as much in CapEx, or But really there is no ensuring that you're going to get paid because it's an investment. You sign that like a million times in these offering documents, right? A bunch of times to say, I know I could lose the money. So the best way is to choose a sponsor team that you trust can manage ups and downs of the market and manage ups and downs of the asset. Because that's going to be your best chance of getting a good return, regardless of the market.
That's amazing. Thank you.
Thank
Yeah.
A
you.
lot of people wanted to hear that. Awesome.
That was a great question.
It is a good question.
Oh, Bethany, before we wrap up, I know a lot of people in the chat kind of had questions about the 8 steps and about the questionnaire. Is that what you were talking about? Ashley would be able to send, and we can send out like a follow-up email how they can connect with you and everything.
Yeah, absolutely.
Perfect. All right.
All right.
Well,
Can we
hopefully
take
if
a
you wanna
photo really
wrap us up.
fast? Yeah.
Yeah.
Okay, I'm gonna stop the screen. Then gallery. Okay,
Awesome.
if anybody wants to be on the photo, can you just unmute or show your video screen, please? That would be awesome.
This was great. Thank you so much.
Yeah, thanks so much,
Oh,
Bethany.
thank you. I always
Hi. Hello, Lay.
let's see your faces.
Come on, beautiful people. Just for a second. Even
There
if
you
you're
go.
driving.
Thanks, Katie.
I'm just joking. Not if you're driving.
Thank
Hi,
you.
everybody.
Denai.
Oh,
Hi.
nice to
It's just-
see you guys.
Here, I want to take a picture too.
Louie, Jonah, Zoom user.
I love seeing everyone's faces. This is awesome. Thanks, guys,
Rima.
for showing your faces.
And
Yes,
Jen,
you
all
can
the
do it.
Brother
You can do it
Lee,
just for a
Jen.
second.
Ed, Christopher, Dante. I'm gonna poke at you guys. Sam.
I'm just gonna call you out by name.
Come on. You can do it. Okay, 10 seconds.
Sorry, my computer doesn't have it. Okay.
Oh, shucks. Okay, no worries. Okay, we're gonna take a photo and 3, 2. Oh, there's Sam. Oh, everybody's popping in.
Here
Wait.
we go. Okay. Like, we
Jonah,
don't want to miss the
what's up,
photo.
man?
Okay, ready? 3, 2, 1. Cheese. Cheese. Awesome. Okay, wait. We're gonna take one more on my computer.
Okay.
And 1, 2. Smile. Yay! Got it. Thank you,
Awesome.
guys.
Awesome.
You guys are awesome.
Thank you
you
so much, Bethany. We appreciate you. You delivered so much value. I know everybody
is
who attended, they
my
stayed
pleasure.
with us, so I'm sure they know that too.
It's my pleasure.
Right on,
Yeah, make
Bethany.
sure
Thank
you
you guys. Thank
reach.
you.
Thank you,
Yeah,
everyone.
reach out. Have
Thank you
Ashley
very
reach out.
much.
Thank you.
Mahalo. Thank you.
Oh, and the recording, how do we,
Oh yeah, we will send that out to you guys. We'll send you out an email that'll have the recording, and then also all of Bethany's contact information will be in there. So all you syndicators who want to set up a fund and contact her, it'll all be in there for you right there, nice and perfect. And I'll wait for Ashley to send me the information, and I'll put it in that follow-up email.
Awesome. Thank you, everyone.
Thank you. Thank you, Bethany.
Thank you guys for tuning in. Have a wonderful day, guys.
Have a
Bye,
good
Bethany.
one.
Thank
Take care.
Bye.
Thank
Bye.
you.
Thank you.
Aloha. That was so good.